Hello and welcome. You're watching the 20th edition of our consumer education series, Nivesh Kar Pepika, presented to you by your trusted brand, Policybazaar.com. And I'm Apeksha Mishra, your host for today's webinar, and we are being joined by some very senior and special guests on the show today. Now, the world around us has changed significantly in the past 12 months than perhaps it did in any point of our lives. The deadly COVID virus has morphed into a global pandemic, destroying lives, jobs, world economies, and personal wealth at a rapid pace. It is time we prioritize our financial well-being and make sure that we are guarded against any unforeseen financial crisis. When managing your finances, remember that playing with the market without adequate knowledge can be dangerous and leads to bankruptcy. So what should we do? We must learn and understand the right trends to take the right action on your portfolio that you have built over several years now. There are numerous plans available in the market, including capital guarantee and guaranteed return plans that promises you guaranteed returns and allow you to lock in the rate of interest for a maximum of 45 years. To help you understand where and what to invest in, today we have with us on the show veterans from the industry, Mr. Sampath Reddy, Chief Investment Officer, Bajaj Allianz Life Insurance Company. Accompanying him is our expert from Policybazaar.com, Ms. Santosh Agarwal, Chief Business Officer, Life Insurance at Policybazaar.com. Welcome to the webinar, Santosh and Mr. Reddy.
Thank you, Apeksha.
Coming to you, Mr. Reddy, first. Now that we've seen there's a lot of uncertainty in a year's time, first wave of COVID, then the second wave of COVID, and now there are talks of the third wave as well. Currently, what we see is that the market is at an all-time high. Do you think this is going to stay? And how is this going to impact valuations? If we could brief our viewers on that.
The pandemic-wise, it has had a significant impact on the economy across the globe. But now with the vaccination progressing quite well in the most of the economies, especially in the developed world, we seems to be pretty much behind in terms of the impact of COVID on the economies. More so in the developed world, the vaccination program has progressed quite well. Most of the developed countries, vaccinated more than 50% of the population. India also, we've been severely hit by the second wave. But in terms of we progressed very well in our vaccination. Of course, given our challenges in terms of relatively weaker infrastructure in the health side and larger population, we have also, even as we speak, almost 15% of the population is covered under the vaccination. So but what is the reason why the markets moved up so much in spite of the pandemic? And how the economies are shaping up. I'll just cover some of those thoughts in the one of the slides. Ever since the pandemic has hit, lockdowns have happened all around the world about 1.5 years ago. Most of the central banks around the world have acted cohesively and put in a lot of amount of liquidity in the market. They saw that because of this lockdown and shutdowns, there's going to be severe impact on the financial markets. There's going to be impact on the the livelihoods of the many people. So along with the in addition to the fiscal support by the government, the central bankers also have put in a lot of efforts and printed large amount of, I would say, currency. The top four central banks alone have infused $9 trillion worth of liquidity into the markets in the last 1.25 years. And in India also, RBI also reacted very swiftly. They have cut the rates by 135 basis points immediately in the last year, and maintained the interest rate very low continue to maintain a very low. And not only that, they've ensured the banking system has a flush with liquidity all throughout these periods. As we speak, also more than 4 to 5 lakh crores of liquidity is lying in the banking system. All of these measures have actually helped the economy scope up very well, and some of them actually lifted the asset prices, like we see stock market and some of the other commodities also, which I'll be covering in some of the slides. So these are the products that we cover, and some of these, any questions around these products also I can cover in question and answer session. So I hope we covered some of this, and over to you, Apeksha.
Thank you, Mr. Reddy. Moving on to you, Santosh now. Mr. Reddy has given us a great brief on what this market scenario is at in the current circumstances, and where should people invest in? And we know that the market is on an upward trajectory. What are the top 3 things that you would say one should keep in mind while investing? And what are some of the tips that you would like to recommend for someone who's just starting off fresh? How is Policybazaar placed to help people willing to invest?
Thanks, Apeksha. I'd first like to thank Mr. Sampath Reddy. That was extremely informative, and thank you for actually giving your views. He's a top veteran in our country who has information on and the ability to, I think, consistently drive performance at Bajaj Allianz Life, and their funds are top rated and have been always performing. So that gives you a sense of what how markets are gonna be, and I think what he shared was extremely heartening to hear, because we are still, though some of us would believe that Sensex is at an all-time high, and we are already trading at say 52,000 levels. Are we overvalued? So the answer is no. There is still opportunity in the market to invest, and I think that is important for some of us to note. I think largely what I would say is that in the past, if you look at pandemics, and several of them, we've seen SARS, and we've seen various other pandemics and epidemics happen worldwide and in India. And what we've seen is there's a sharp recovery in the market post these epidemics and pandemics. What we also saw was the recovery last year itself, when COVID actually the outbreak happened in later part of March. Markets actually crashed quite a bit, but within the next year, in the next 12 months itself, we saw markets really recover, right? And we are at an all-time high. So I think that should also give you some sense of the fact that these may be pockets of opportunities for one to invest. Having said that, Mr. Reddy did touch upon what is the outlook for the next 10-15 years for India, and what should one expect when you're investing in either equity or debt. So I think the fact to keep in mind when investing is what is your own aptitude, or what kind of investor are you? Do you have the ability to delve with equity? Are you okay with taking some risk? And if you are okay with taking some risk, and you're okay with a long-term view, then equity is actually the best way to invest. And equity markets could generate, over the next 10 years, could generate in the 10 to 15% range. The return could be there, and hence, that may be a good way to invest. But if you don't have the ability to actually take risk, debt may be a good way to invest and stay invested in the market. And even with debt, right? If you invest in debt through, say, a ULIP plan, which is a market-linked plan, but you choose debt or bond fund as your choice of investment, what will happen is your returns will be safe. You can expect to make about 6 to 7%, but that's going to be almost very close to, I would say, guaranteed. You can't obviously ever guaranteed any kind of market-linked return, but bond funds are not very volatile, and they could give you easily 6 to 7% return. So if you don't want to take any kind of risk and want a secure return, you could settle in for a bond fund. So basically, I think first decide for yourself what kind of ability or what is the objective behind the investment, and at what age are you? Because when you're an early investor, and when you're young, you could have an equity exposure for up to 70%. So if you are, say, sub 35 years of age, your equity exposure could be as high as 7%. But as you age, when you start getting closer to retirement, one would not recommend having more than 30% of equity investment, right? So these are some basic thumb rules that one should keep in mind. Having said that, you see veterans and you read these articles in media all the time saying that by December the market should be at 60,000, and by 2025 the market should be at 1 lakh points. So which means that there is ample opportunity to invest. India will still be the best returning, I would say, ROI destination. So that tells you that the rally is not over. There is still opportunity, and if you have excess money, choose what you are okay with. You're okay with decent, slightly muted returns, then go for debt investment. If you are okay with taking some risk, go for equity investment. I think the important thing to remember when you go for equity is don't look at your investment every day. I think take a horizon of about, at least if you can take a 10-year horizon, nothing like it. And over a 10-year period, you should get decent return. Moving on, I think this is one unique product that we've crafted, and this could be a good way to invest, where we've combined, instead of a retail investor who may not have the ability to appreciate or understand some of these products, which can be quite, at times it can be overwhelming. So what we've done is we've crafted these products by combining debt and equity ourselves, and these are experts looking at a customer's age and then suggesting what is the right mix of equity and debt, and thereby combining these two products, so that for the customer it is one investment, but at the back end the product is structured in such a way that the amount of money that you invest will always stay protected. So you need not, even though you're investing in the market, you will always find that your capital is guaranteed. So if you say, for example, invest a lakh of rupees for 10 years and you've invested 10 lakh, what this product does is 10 lakh rupees will be guaranteed. And then because you're investing in the market, whatever market upside you get will be the benefit that you get. Because a lot of people, right, though they want to, I would say, get into equity and want to experiment and start, a lot of people burn their hands by investing in stocks and then kind of totally shy away from investing in equity completely. I would say that this is a midway solution, a solution where you don't really have to apply your mind, and at the same time your investment is taken care of from an efficiency perspective. So you need not worry that your hard-earned money will go down the drain, because this guarantees the investment that you make, and at the same time will generate return for you through the market-linked investment. So this is one solution that you will find at Policybazaar. And for first-time investors, for investors who do not have too much, I would say, knowledge of the market, this may be a good way to start your investment. It's called Capital Guarantee Solution. We have one listed here, which is from Bajaj Life, where we've combined two products. One is equity-based, one is debt-based, and these two together will provide a good, efficient solution for investors. There is another category of plans which are called guaranteed return plans. Here, the amount of money that you invest is completely locked in debt. This is not a mix of equity and debt. This is completely debt-based product. What this does is it tells you, when you, at the time of investment itself, what is the final return that you will make. It is very similar in terms of an operating structure to a fixed deposit. So when you invest in a fixed deposit, you know what is the rate. The rate of return is guaranteed and is known upfront, and hence you know at the end of the period what is the money that you will make. So this is a similar format. This is interesting now for three reasons. That this is the first time in the last 20 years since privatization happened in India, and you saw life insurance companies launching these products, that this category of product gives you a higher rate of return than fixed deposit. And this has never happened in the past. In the past, fixed deposits always gave a higher rate of return than guaranteed life insurance plans. But actually now, because fixed deposit rates have been cut and over the time they've gone down, these plans have become more efficient. Having said that, they're also more efficient from if you compare them to an FD, because both the investment amount, which is the amount that you invest under ATC, 1.5 lakh rupees, you're eligible for a tax rebate. So you can file that under ATC, and you will save tax on that. And the best part, which may be lesser known to retail investors, is the entire maturity that you get. So if you say invest 10 lakh rupees, and in 10 years this becomes 20 lakh, the entire 20 lakh is completely tax-free, unlike a fixed deposit, where on the profit that you make, you will have to pay tax depending on the tax slab that you are at. This return is completely tax-free. So the entire 20 lakh that you will make here will be completely tax-free. So you get benefit of higher return than some of the FDs that you see. The upfront amount, which is the amount up to 1.5 lakh is tax. There's a rebate under ITC section, and the bigger part, which is the maturity benefit that you get, is completely tax-free. And because it is a life insurance product, there is a life insurance cover that you get along with when you invest in a product of this nature. So that's the added benefit. We understand that you're not investing here for life cover, but just so you know, this is an added advantage that you have. So generally 10 to 14 times is the life cover. So if you're investing, say, a lakh rupees, generally 10 to 14 lakh will be the life insurance cover that will be attached to your policy. And if something happened to you, during the policy period, your family will get this money. So I think that there is advantage in having security, especially in times of this nature. In COVID times, where some of the other life insurance products, which are pure protection products, may not be very easy for you to get, given that you have to go through medicals and there's a lot of onboarding process required there. This may be a good way to generate very good return, and at the same time keep yourself covered through protection. Just so you know that it's a format, the only format that allows you to compare, all insurance companies that operate in India. There are 24 life insurance companies. You will find plans from 15 companies that are online at one place. The ability to compare and see which is the best investment for you, or which is the best term insurance plan for you, or which is the best health insurance plan for you at one, I think, place, being able to compare and not just saving money, but also getting advice on what is right for you. I think this ability is unique, and hence we kind of, in this space, which is called the aggregation space, we have 90% market share.
Just a quick note for everyone watching in, we'll be also posting this session on our Instagram page. So in case you've missed out on any of the names of the products or anything, you can stay tuned, and after we post the session on the Instagram page and all social media channels, you can again go through them, and can also mail us on Policybazaar show @policybazaar.com. We'll help you and take you through all the products that Mr. Reddy and Santosh both mentioned. Moving on to the questions segment, we have a lot of questions pouring in. First question, I'm moving to Mr. Reddy here. We have a question from Irshad Kumar. He says, what is the best investment scheme which provides capital protection along with the possibility of good returns?
As I talked about, entire gamut of investment styles we have been offering, whether it's a unit product, which is oriented funds, as well as debt oriented funds, and then the guaranteed income goal, which is like a fixed return product. So for an investors, I would think, for an investors who are a little bit risk averse, are looking for, capital guarantee, which means that the amount that they are investing, should at least be, capital should not be lost, and, at least that much of money should be returned. Over and above, let's work towards, making the returns better and better by participating some amount of equity. That kind of a structure we have, which is called the capital guaranteed plan, as explained by Santosh in one of our slides. The way it works is that some portion of the money that you invest will be invested in the fixed income product, which is for us, and some of the money, more or less about 45-50% of the money will be invested in the smart SWG. Under that, you can choose different styles, again large cap equity or a mid cap equity combination. It's like a combining together with these investments, some investment into these two products depending on the age. With this, what will happen is over a period of time, your the fixed income portion will earn you steady constant return, which will make good for your bare minimum capital that you are giving with us, and another portion which is actually working for you in terms of generating a little bit of higher returns by investing through the equity market. I think this could be a good product for the investors who are a little bit risk averse or looking for a capital guarantee.
Absolutely, and we've already gone through it in detail. Moving on to a next question from Aravind. Santosh, The question here is, what is the difference? Aravind wants to know, what is the difference between a long-term investment and a short-term investment plan, and how does it work on the parameters of risk, ROI, etc. And what do you advise? Which one should we go for?
Say a short-term investment would be, you pay for a short amount of time. Say if you invest through, say, ULIP, which is a market-linked plan. You choose your investment and you can pay for, say, 5 years and choose to get your money back at the end of 5th year itself, right? And short-term investments can help you with some goals like buying a car, etc. And generally, when you make short-term investments, do not expect the returns could be volatile, because, and especially if you're investing in equity, you can't really say the last 5 years have been great, but not necessarily the next 5 years may not be great, right? So when you invest for a short term, just be aware that if you choose equity, the returns may not always be in your favor, and don't get surprised if you end up losing money. So I think that is one thing to keep in mind. And if you do not want to take that risk, then go through a capital guarantee kind of a solution where you have the ability to pay for 5 years. At the end of 5 years, some part of the money you can withdraw if you need liquidity, and some part will stay invested. So that is one thing that you need to keep in mind. And it is, even if you invest through ULIP or if you invest through, say, mutual funds, the story is still the same, right? Because eventually it is the money is getting invested in equity, and hence there will be volatility risk that you will take, which gets, I think, muted if you take long-term products. Now, if you take long-term, when you say long-term investment products, one is expecting at least you to invest for 10 years and beyond. And some of the larger or bigger goals in life, if you have goals of, buying a house, or especially investing for your child, for your child's education, for their marriage, some of these bigger goals in life that one may aspire or to have, I think you can link your long-term investment to these goals. And then you have to be disciplined about it. Invest money in the monthly fashion. Invest for 10-15 years, and then even if you buy equity, you may not be very. I would say you can expect a decent 10-15% return. So don't get overly worried, and don't look at investment day in, day out. And I think equity is a better suited instrument for investing in long term.
Absolutely. Hope, Aravind, that has helped you with the answer. Santosh, a very valid question here by Mohammed Abdul. He's asking, do we get any extra returns by investing online?
Absolutely, you do. So, a lot of companies, because when you invest online, you're doing a lot by yourself. There isn't somebody coming at your house or your doorstep to kind of explain the plan to you, etc. So the expenses that are incurred in selling a plan to you are much lower because of an online way of distribution, and that expense that is saved is then passed on to the customer as a discount. And hence you will see in a lot of plans, if you buy online, you will save almost up to 3%, and 3% can be meaningful if you're investing a big amount of money. And if there is an ability to save, why not, right? Even if it is 1% or 3%. So I think you do save when you buy online. At the same time, I think more importantly, when you buy online, you can see what you're buying. The product is explained there. You exactly know what you're investing into. You will know, you can read about it. You can research on your own, and you will fill some of the details yourself. So I think the ability to go wrong or not knowing what you've bought is almost remote. And I think that is more important.
Absolutely, not just extra returns, but there's a lot of transparency that is the need of the hour, because we are all sitting at home and buying from our homes. So that is very important to us. Mr. Reddy, coming to you, we have a question from Dheeraj Gururaj. Out of all the plans that you took us through Bajaj, he wants to know which of these products would you recommend for NRIs?
It's not, really products are based on the NRIs. I would think that, selection of the products should be more based on what is one's risk appetite and what is one's expected return, how soon liquidity needs and how soon the money is needed, etc. Those are the factors which are more important factors. As I discussed, for one of the product one could consider is a combination product, which is like a capital guaranteed product for investors with relatively less risk, or rather risk averse investors. Or one could look at market link product, which is unit link one, which is SWG. Under that again one could choose different investment style. As Santosh has explained, investors with a very long-term horizon can certainly look at equity products, because the equities in general generate a superior return over a period of time, of course, but they do come with its risk of volatility. I mean, the volatility gets reduced as you look for a longer-term perspective. Like if you look at the equity markets as such, in the longer term, 12 to 14% is a very fair return to expect from the equities. And similarly, based on the current interest rate structure, about 7% return is the fair to expect from the fixed income product. But whether it's 12 to 14% equity return is not a uniform one. 1 year it could fall to 10%, the other year it could be up 20%, like that. So that's why when one is looking at investment plans or investment strategies, one should look at the time horizon into time horizon is an important element. But they don't. The 10 to 12%, as I said, is not a straight line return that you will get in the equities. But having said that, when you look at the equities in the longer term perspective, the risk volatility aspect gets minimized dramatically. You go back and analyze the market in the last 10 years or 20 years, of its history. If you look at any one of the years, the volatility is quite large. 1 year you could have got 100% return or 80% positive, and another year, it happened to happen to be last year, which is pandemic year. Market will decline by about 25 to 30%. So, but if you look at any 2-year period, the volatility, comprises much more. But if you look at any 3-year return, the extent of decline to the extent of rise, that compresses more. And similarly, on any 5-year return, pretty much, losing of money is pretty much get eliminated. On a 10-year basis, almost it's pretty much that, even if the markets go up and down, even if it's going to be a pandemic year, even if it's going to be war, even if the crude prices rise abnormally high or inflation goes through the roof, even then, on a 10-year basis, you would still have, very healthy positive returns. So it's a more of a time horizon is a factor that you should look at it. Where you're based, not really concerned whether you're in India or whether you're, non-resident India. That really doesn't make a difference in terms of choosing.
Absolutely, yeah. So it's very important to think correctly before you start investing, and that's the message. Hope your query was answered, Mr. Reddy. We also have another question for you from Shufaj. He is to say that what are some of the investment schemes available with Balik, and what is the ROI structure?
We as a company, we have an entire gamut of investment style for the customer. We offer the unit link products, which are NAV driven, daily NAV driven products. You can see the NAV on a daily basis. Of course, you are subject to the daily volatility in the market. And at the same time, we also have a non-par product, which is which is guaranteed return product, which is like a guaranteed income goal. We also have a flexi product, which is flexi income goal, which is again the participating product. So these 3 products all taking together suit different customers, different requirements. But between the debt and there's a liquidity as well. Whether it's market linked one, which brings in with volatility, whether it's a non-participating fund without any volatility, all kinds of product structures we are offering. And not only that, the cost structures have come down dramatically over the years in the insurance space. Especially for the investors who are staying for the full term, there are insurance costs or even allocation charges have also very much getting returned. So you have to look for see what is attractive for you in the entire gamut of the products that you are offering.
Absolutely, coming from the veteran here, so I'm sure everyone listening to us is now absolutely clear of where and what to invest in. Moving on, Santosh, we have a very valid question here talking about debt funds. Saeed J. Khan has his question as, if debt funds are giving 6 to 7% returns, why not lock your money in bank?
There aren't fixed deposits that give you 6 to 7% of return anymore. So if you see fixed deposit returns, they're in the 5.5% range. That's one. And second, the return that you make through a bank product will always be taxable. So that is, I think, important for people to understand. And especially for NRIs, where the level of income is much higher, you most likely will be in the higher income bracket, and hence your tax rate or tax slab will be higher. And you may attract up to a 30% kind of a tax on the profit that you make. If you invest through a bond fund through debt, then basically your return is completely tax free. So the 6-7% return, if you were to compare this return with tax adjusted return, and then that's the right way to compare it. So first apply the tax slab that you are at, and then see you will find the difference in return, because 6 to 7% will actually start meaning about 9-odd%. So that is how you need to look at when you invest in a bond fund versus a bank product.
Moving on to Mr. Reddy here. We have a question for you, Mr. Reddy. It's from Vishal Buramkar. His question is, investors have concerns regarding UL charges. Any comments on this? Please suggest good UL plans that we must go for.
As I mentioned, over the period of time, UL charges have extremely become competitive, and charges have come down dramatically. In fact, there are products with written off mortality charges, which means whatever the charges that we are giving you you are paying for your insurance cost, some of those charges are also getting returned at the maturity of the policy. And in fact, our SWG is also offering the return of the allocation charges. Overall, I think the charges have come down dramatically in the unit-linked space. Our SWG is one of the most, I would say, competitive in terms of the overall charges. I would think that overall the fund management under the unit-linked insurance plan, the overall the cost of managing money for you, taking the benefit that you get into the insurance, I would think is one of the best vehicle that you could find. So the charges are really come down and highly competitive on any other typically investment vehicle that you have. And in fact, now just saw one of the questions as well. Do you have an ethical fund under this? The ULIP plan of our SWG? Have the pure stock fund, which is managed under the ethical strategy, which means we do not invest in the banking and the financial sector companies, and as well as tobacco and hotels kind of sectors. So yes, we do have even the ethical fund under the SWG plan.
Mr. Sampath, there's one more question from you, by Mohit Trivedi. And since we are in flow, I would like to ask you quickly if you would want to say which is the best investment option or plan for 10 years.
Yeah. So, as a person representing the investment department, where we are offering the entire, gamut of investment products, and for me, it is difficult to choose, say this is good, that is bad. All of our investment, strategies and funds that we selected and we bring it up for the customers to buy, all of them are, managed with the same amount of vigor, energy, and details by each of the fund manager and the entire investment team. For me, all of the funds are good, and it's for you to choose which one suits you the better. Suppose if you are the one who are elderly person and looking for an investment, looking for the cash flows and needs in the near term, probably may look for the fixed income oriented kind of product. Suppose you are a person who are young and wanting to save and grow your capital from a longer term perspective, given that you're already working and that is taking care of your needs, you should look at equity oriented products. So that's how I would say, from my perspective, all funds are good, and we are taking utmost care in terms of generating good returns from each of the funds that we are offering.
Absolutely. But since we are speaking on the 10-year timeline, we have another question from someone, I don't see the name here. His question is, how do you compare real estate investments versus capital guarantee over a 10-year period?
Okay. So, continuing in the same thoughts, having said that, you have to choose what you like, what your expectations are. But any investors with a longer term orientation, longer term needs, which is 10 years, I would certainly think is a good long term period. Investors with that horizon should look at the equity oriented products, because in the longer term, as I said, even the equity markets are volatile in a 1 year or a 2 year or 3 year basis, but when it comes to 5 and 10 year basis, the volatility gets down dramatically, and most likely the return will be far superior as compared to the fixed income return. So, in the longer term, I would strongly recommend the equity oriented products. And secondly, a lot of investors are thinking that markets have gone up and it's already since 55,000 level, 50,800 level. What are the, is it too high? Is a worry. But see, look at, as Santosh is pointed out in one of the presentation and articles, longer term target for the Nifty and Sensex. So look at, even if the Nifty were to go up, equities were to give just about 10% return per annum over a 20-year period, the Nifty has to be from 15,800, it has to be more than 1 lakh. So if the return expectation were to be somewhat slightly better, about 15%, can be higher than 250,000. So that's the level of the index over a long period of time. You will see. Do not worry about what the Nifty or Sensex is today because of this compounding effect. Because that interest the returns are going to be compounded in this for a long period of time. The absolute number will keep hitting into high and high. And to answer your question on the real estate versus the fixed income product, it would be difficult to answer for that. But one thing I would say that real estate as an asset class may give a good return, but the challenge there is the ability to move in and move out, and liquidity aspects will come into the picture. So you have to take those things into consideration. It's not something very easy for an investor to walk into a real estate investment and walk out. It requires a lot of amount of efforts, and also those liquidity factors should also be taken into the consideration. Yes, we as a company are offering predominantly investment asset classes, investment strategies around the debt and equity investments. But real estate, is as I said, could give a good returns, but have its own challenges like ability to come in, get in and get out, and liquidity aspects. Those things also.
All right, a lot has to go before you start investing, and a lot of options like Mr. Reddy mentioned at their end as well, at Bajaj's end as well, that you guys must keep in mind. One last question from Santosh, and we'll wrap up this session. Santosh, I hope I'm audible. We have a very good question here. As an NRI, if I'm investing in annuity plans, any income tax implications for long-term capital gains for an NRI?
See, annuities are basically taxable products. They do not have a life cover, and the reason why the other investments when you are making through a life insurance products are tax-free is because there is a life insurance component, and that makes the investment tax-free. Annuity is the exception to this because annuities don't offer a life cover. It basically offers you pension for till you live. So on the pension that you receive, whatever is the tax implication for you, depending on what is your tax bracket, you will have to pay income taxes on that.
Absolutely, and this is a very well briefed and informative session from our veterans in the industry here, Santosh and Mr. Reddy as well. And quick note of thanks to everyone. Thank you for joining in and listening to our session. Just a quick reminder, in case any one of you have missed our session and want to go through it once again, you can stay tuned to our Instagram page, and we'll be posting the session. You can have all details of the plans that Mr. Reddy and Santosh both mentioned, and you can also mail us on the ID I just mentioned. Thank you everyone for tuning in. Thank you both the guests for your time and explaining to our viewers, if they haven't started investing, they should quickly start now and not wait further. Thank you so much for tuning in.